So we've got an exciting space lined up. We are going to be talking about how we can solve the student loan crisis that is being faced in the U.S. And there's been a lot of conversation around this recently. But what has really been shocking to me is how many people, not just people right out of college, right out of graduate school, that are experiencing this debt, but how many parents through the Parent Plus loan program, and potentially people that are even retiring that are still paying off their student loans. And so we have our chief economist, Dr. Robert Murphy, here with us today, our directors of our agency, George Roth and James Pollard, and our senior agents, Liz Lamond and Wayne Durksen. And we're going to be talking about how we think we can solve the U.S. student loan crisis through cash management with whole life insurance. And so with that, Dr. Murphy and I are going to give a little bit of a primer on the student loan crisis that we've been seeing in the U.S. so far. And so I started to get into it, but it really is a problem. There right now is about $1.7 trillion in outstanding student loan debt in the United States alone. And we're going to see another $100 billion added to that figure throughout the academic year of 2024 to 2025. And this number is just going to keep inflating as we see the cost of higher education continue to rise. And like I started to mention earlier, there's an increasing amount of debt among our older adults in the United States. This is really just because, one, of the higher cost of education and more people needing to take out these loans. And two, this has also led to potentially risk of their Social Security benefits. We've seen since 2002 that adults getting their Social Security benefits garnished has 5x over this 14-year period, which is shocking. And with that, we've seen some legislative efforts to try and protect borrowers. I don't necessarily have opinions on it, but I'd love to hear potentially some of your guys' opinions on the legislative efforts that have been made in the U.S. But it really is a provocative, hot button issue right now that we're excited to dive into today. Dr. Murphy, am I missing anything? Or would you like to add anything yourself on the student loan crisis?
Sure. So I'll just add, thanks, Jackson. I'll just add a few points here. And then, like you say, mostly what we want to focus on here is, if you're tuning in and you have student loan debt, or, somebody who does, how can Infineo help you get out of that? But in terms of just the big picture, so Jackson said right now, the estimate, there's something like 1.7 trillion of total U.S. student loan debt. And of that, the U.S. federal government owns 93% of it. And I think, this was something that I wasn't fully aware of myself until I looked into it this a couple of years ago, that it hasn't always been like that, right? So it's not just a fact of nature that, the U.S. federal government owns all the student loan debt. That was something that really came in through, it was when President Obama first came in, and I think it was what was it called? The ARRA, the American Recovery and Reinvestment Act, that it was called the Obama stimulus package, if you remember that, when he first came in, it was right after the financial crisis. Because up through 2008, it was really the federal government only owned, I'm just looking at the chart here, something like $100 billion or so of student loan debt. But like I say, now it's gone well up, 10 times that. So the proportion of student loan debt owned by the federal government really has just skyrocketed since 2009, let's say. And it just marched steadily upward until now they basically, have the whole market. So besides just that being a weird, thing, that there's financial repercussions that in terms of, it's like you don't want the federal government investing in those types of assets on behalf of the taxpayer. You'd rather have some other people managing your investments rather than politicians, but also too, just because how politicized everything gets, right? So it's very popular, of course, like during the pandemic to say, let's put a hiatus on student loan payments and so forth. Well, but that has financial repercussions. If those things are assets that are being held in theory on behalf of the taxpayer, well, that matters. It's not just a matter of giving goodies, or of course now with all of the quote forgiveness of these things, that again that has financial implications. And there's also all sorts of issues too. Which is the last point I'll make here is I'm sure you've seen where there's arguments about, well, gee, if we forgive it, that people are casting as these poor struggling people, but if there are working class people whose kids aren't going to college or who go to a cheaper community school and they're getting in-state tuition and stuff like that, then in effect, it's like working class people are subsidizing the children of upper middle class households in order to give them an advanced degree or, give them a degree, which that doesn't sound right. And yet that's the kind of thing that's happening. And of course, there's other stories too about people who, if they had known the student loan forgiveness program was going to be, come on the line, they wouldn't have so aggressively paid off their loans up till now. So there's all kinds of things like that going on that just introduce everything. And then other big picture too that, bothers me is it just gives the federal government that much more control over, higher education in this country, which other things equal, I don't think is a good approach. So for all these reasons, besides just the impact on the individual borrower who would like to be able to get out from under this crushing debt, there's all sorts of other social reasons that I think if Infineo and other organizations can help people get out of their student loans faster than otherwise would be possible, it's going to be great for everybody. Okay, Jackson, thanks. I'll turn it back to you.
Beautiful. And that definitely added some more color that I wasn't able to give. So thank you for adding that there. And so I think what I want to do next with this is potentially introduce our solution. And James, I was actually going to ask you to speak here. Did you have something to add?
Yeah, I wanted to just point out that, and I think most people know this, but even a week ago, the current U.S. administration talking about all the student loan debt relief, $7.4 billion, I believe, was the number. And it sounds like a big number until you put it up against the actual debt that there is, and it's 0.004%. It's 0.4% of what they're talking about. It's political theater in an election year, and it's not really solving much for anybody. So that's kind of what I'm going to add to that piece.
Oh, I completely agree there, James. And what I wanted to move into next was kind of how we think that at Infineo we can solve the student loan crisis in America through implementing cash management with whole life insurance and what that really means and where this strategy came from. So as our former director of product development and now our director of our agency, I feel like you could add some really great color onto what we're actually talking about as the solution here to the crisis.
Yeah, thanks, Jackson. Having people not get into student loan debt, I guess, would be my first solution, but that's obviously not the case. So, we have to solve the problem that's in front of us. And a lot of the cases, number one, we're not miracle workers. People actually have to have jobs and real income and some form of surplus. Even if they might not realize they have one, working with us, we can often find some surplus in their budget. But we do need something to work with. But for a lot of the people that have the student loan debt, it's not so much that they can't pay it necessarily, it's that they don't know which to prioritize, which financial decision should it be paying off their debt, should it be saving for the future, should it be saving for their down payment on a house, even though they're 35 years old and still living with mom and dad. There's a lot of priorities and they don't know which one to choose. One thing that this solution does for people is it allows them to pay off their debt and save for the future or save for that house at the same time with the same dollars, simply by properly structuring whole life insurance and utilizing it, as Nelson taught us all, using the infinite banking concept, cash management with whole life. There is a solution. We have built proprietary software to show clients how they can pay off that debt and still have all or most of that money available once the debt is paid off to utilize for something else. So it takes away the hard problem they have of which way do I put my dollars. Now they can do two things at once.
That makes a lot of sense to me, James. But for our listeners who it might be their first time tuning in, it might be their first time hearing cash management with whole life insurance, I think we should probably take a step back here. And I want to open up to our entire panel here and just ask the question in the simplest way possible, what is cash management with whole life insurance? And what is this process that we're saying people can do to take control of their financial situation to both save and pay off their student loans at the same time?
Okay, I'm going to jump back in. Simply put, and I'll speak from personal experience. When I first heard this term, the infinite banking concept, what struck me out right away was concept. Was this something new? Is this something unproven? Is this something risky? And quickly looking into it, the answer is no. I mean, the ability to do this, and I've said this many times, has existed for about 175 years in North America. We know families for more than a century that have been doing this very thing. The late R. Nelson Nash was simply the first person, at least to my knowledge, that actually wrote down, put it in a book, went out and taught it to the public on how to utilize whole life in this manner when you structure it the correct way. So, the infinite banking concept is simply the name of the process of how you can take over the banking function in your life by utilizing a whole life policy, or policies primarily for most families, ends up being multiple. But it's just a different way to store their capital. It's a different place to hang on to it, where they can then deploy it to solve problems like we're doing here today.
Great. Does anyone have anything to add there?
Sure, I'll add to that. Can you guys hear me okay?
Hear you perfect.
Okay, awesome. So just to add on to what James is saying there is most people, when they think of life insurance, they think they have to die to win. They have to pass away before any benefit is paid out. But the way we structure these policies, which is the product that we use to implement the concept and the strategy that James talked about. So you can do multiple things at the same time with this product. It provides a cash value, which grows equity, and then we can leverage that equity and then put our money to work in more than one place. So we can give our money 2 to 3 jobs at the same time. So we're maximizing the efficiency of our dollars. We're managing the flow of cash through our lives and maximizing the efficiency, and it comes with guarantees. So the cash value is guaranteed to go up. It can never go down. The death benefit is guaranteed for the rest of your life. It can never go down, but it will likely go up if we do it correctly. The other thing is the premium, the cost never goes up. So we have an asset that's growing in equity with guarantees that the cost will never change, but the value will always go up. So it's an incredible tool, and paying off debt is one use case for this tool and this strategy. And because it's such a problem, especially in the US, the use case is very apparent. And that's really what we're up to here.
I love that, George. And so I'd love to now ask you guys, do you think that there's particular urgency for people dealing with the student loan debt crisis to utilize this process and pay it off, as opposed to just someone with any other sort of debt or in another situation? Why is it particularly urgent for people with student loan debt to learn about this strategy and potentially implement it?
So I'll jump in. This is Bob Murphy. So here I'm just speaking for myself. This doesn't represent necessarily like an institutional infineo position, but as an economist, I do think that the Federal Reserve has kind of painted us into a corner in terms of Americans, and that there is going to be a bad recession that I think will be apparently beginning later this year. And so, what's going to happen? Yeah, they might try to cut interest rates, but inflation is worse than their official targets, and even using their own numbers. So I think they're not going to have as many options even to do the short-term solutions to sort of give relief that they otherwise would have. And so I think that, the Fed has squandered its goodwill, as it were, by having all these years of basically 0% short-term interest rates. I don't think they're going to be able to go back to that. And so for all these reasons, again, I think you as an individual or a small business owner, or whatever your personal employment situation is, you want to get as nimble as possible, as fast as possible. And with the kind of asset that this program uses, it just gives you a lot of flexibility. So like everyone's been saying, yes, this particular use case is it's going to show you how to pay off your student loan debt years ahead of schedule. But beyond that, you have now this very versatile asset that gives you a lot of options. And I think that's really what you're going to need in the near future as an American or a Canadian, is just to have a lot more options and have a lot more liquidity at your disposal.
Yeah, I'll just add to that as well is one of the things, and correct me if I'm wrong, but based on my understanding of the rules in the United States, that there is no escape from this type of debt. If your financial position collapses and you have to start over, you're still starting over with this debt in Chapter 2. Is that correct?
Right. Yep, that's right.
And then additionally, on that same note, I mean, there is all this federal student aid that we're talking about, but I've even heard that there's been big delays with the FAFSA applications and just people even being able to get their applications through and approved. And so it's leading to less and less people feeling that this is even a certainty. And so people are looking for other solutions right now, which I think is another particular pertinent reason. Liz, do you have something to add here?
Yeah, I was just going to say, I think, often the point that was made earlier about being able to save and do this is huge and should be reemphasized, and having access to liquidity. So something that I found is really appreciated by people who are implementing this solution is the flexibility. So we're going to show people how to pay down these, whatever debt they have, student loan debt, mortgage debt, faster. But the product, whole life insurance, is not tied to any one of those items. So there's a lot of flexibility. So should life change along the way, you can use the insurance for a lot of different purposes. So if you need extra liquidity for something, or there's an opportunity, so you're not tied into doing that for the time. We're going to show people a plan, but plans change, and having that flexibility. And as Dr. Murphy spoke about, economics times changing, certainly something that happened during the pandemic where economic times changed, and what did people need? They needed access to liquidity. So building something where you have that reserve and that access to liquidity is always going to be important, no matter what your circumstances are.
The one thing I would add to all of that is control. So the last thing that we want, I would say, not to speak for everyone, but I think the last thing that we want is to give up control and not have options and not have choices. So anytime we put our faith in the government to take care of us in any way, regardless of what it's about, it's not going to work out in our favor. So we never want to be reliant on government for anything. And we want control, flexibility, and liquidity. And that's really what we're talking about here.
100%. And I definitely agree that our student loan minimizer solution achieves all three of those prongs that you just mentioned there. But maybe for our listeners here who aren't as familiar, I know we've at a high level talked about what we're going to do here, and we're going to use a properly structured whole life insurance policy to pay off student loans. But what does that really mean? James, if you could potentially dive into like the guts of the student loan minimizer and what really is going on in this process, and how it's going to help individual students climb their way out of this hole that they're in. If you have any examples that could potentially also be helpful for our listeners.
Thanks, Jackson. Well, I mean, I can paint a bit of a word picture without actually showing people. It's a little tricky to do, but simple. I mean, we look at people's finances. We determine if there's some surplus room in their budget, because two things we're not trying to do. We're not trying to increase people's expenses, and we don't want to force them or ask them to reduce their current lifestyle. Within that process, I will say that reductions in lifestyle sometimes happen simply because once people actually look at what they're spending and where they're spending it, it's a voluntary choice to reallocate some dollars, but we're typically not here to point that out to them. Once we have that surplus budget, then we're looking at a bit of a balancing act on how much of those surplus dollars should go directly into a policy and how much should be used outside of that policy. So I'll give you an example. I'll just give a random example. Let's say the surplus was $10,000 per year, and we chose to put $7,500 or 75% directly into a policy. Well, we would do that, then we immediately would borrow against that policy and take that policy loan and pay it down on some of their debt. Now, depending on the type of debt, if it's a credit item that has interest-only payments, as you pay it down a percentage, the payment comes down an equal percentage, and those dollars would flow back towards that policy loan. But in addition to that, at the beginning, I said we're using about 75% of their surplus directly into the policy. That other 25% would be paid directly towards that policy loan that they just took to reduce their debt. So that's a bit of the balancing act, is the more efficient use of those surplus dollars. And we can find the sweet spot very quickly for these clients. So at the end of the day, they're putting their money into savings first, which is going to compound on a tax-free, tax advantage, but it can be tax-free if you use it correctly. For their entire life, that money is in there and growing. And because it's in there and growing, we're allowed to borrow from the insurance company, who simply places a lien on your policy. They do not remove the dollars from your policy to do this. So when you're borrowing money, the money comes directly from the insurance company, not out of your actual account, out of your actual policy. Your money is in there and growing the entire time. And over the number of years, that's where the advantage really comes in on these policies, is you've locked down your money, you're going to grow it for the rest of your life. Because it's there, you get to leverage against it. Each year, because we're taking money out of the policy and we're putting money back in on a monthly basis, typically, each year the loan available to you is that much bigger. So it quickly eliminates the debt. But remember, every year you're capitalizing, putting that new premium dollars into that policy and growing it. So we looked at some examples in our last webinar where people paid off, $200 and some $1,000 of student loan debt in 5 years. But at the end of the 5 years, they had more than $200,000 in savings at the same time. And that can only be accomplished by, number one, how we calculate the solution within our software. Number two, by properly structuring that policy. And number three, finding the sweet spot, how much money goes directly to the policy and how much of that surplus goes to service the policy debt. So I know it's a bit of a word salad for folks. It's hard to see that without some graphs and some pictures on this, but it's a very efficient system. When we plug the client's data into that, it's very quickly they can see exactly how it works.
I think the other thing that I'd add there too, James, is so you're paying off the debt, but regardless of what the debt is, if it's student loan, mortgage, credit card, whatever it is, automobile loans, as you're paying that debt off, you're now freeing up extra cash flow too, right? So those payments are no longer required. And then they can be put back in through this system, through this process, and everything snowballs, right? So the cash that we have available to us is growing, guaranteed. The amount of cash flow we are increasing to the positive. And then when the debts are all gone, that's the boring part, as James says. The boring, unfun part is done. The debts are gone, but you're still left with a pile of cash that you can now use for whatever purpose you choose, whether that's for your retirement planning, for kids' education, property, whatever the case may be. So it's that multitasking of our dollars and then the snowball effect that we can generate that really makes it all work.
With that, I'm going to just pin a tweet right now that has our Student Loan Minimizer webinar link there. So if you're interested in seeing those examples that James was mentioning there in more depth with the graphs, illustrations, and numbers behind it, you can sign up for our next Student Loan Minimizer webinar at the link in the pinned tweet there. And on that note, I would love to kind of dive into how any conversations you guys have had around the Student Loan Minimizer with people with actual student loan debt. How are they feeling about the solution? Are they feeling like this is a way that they're actually going to be able to tackle the debt in their lives? Are there objections? Are there common objections you guys are seeing? If so, what are they?
Did we lose Jackson, or was sorry, Jackson? Okay. Your question complete?
Yeah, I thought so.
Okay, yeah, sure. I think the first one we hear, not just on student loan debt, but on any debt that we're tackling with this strategy, is it's too good to be true. or how come I didn't know about this before? Because I mean, it's not taught. It's not taught in a financial system. It's certainly not taught to insurance advisors. It's knowledge you have to seek out for yourself. But once it's there and you understand it, it becomes pretty self-evident. But yeah, I think the number one thing is, that looks too good to be true. But the fact is, I believe Todd Langford said, if it looks too good to be true, ask more questions. That doesn't mean it's not true.
I love that. Liz, George, Wayne, anything you guys have seen in conversations?
Well, I'll jump in while people are thinking. This is Bobby. So I'm not directly in production. I'm not working with clients per se, but what I've been moderating the webinars that we put on, showing the solution to people. Sometimes in the comments, people will say things along the lines of, if I'm just paying it off, like, in other words, like there's no magic money pump here, right? That you have to have a surplus to be able to pay down debts, and we're not giving you more money. And there's a sense in which that's true, that yes, we're not giving you some goose that's laying golden eggs here. But on the other hand, there are some, if you want to call it arbitrage opportunities, or I don't know what term you want to use, but partly what goes on in these particular case studies where, the numbers check out and people can, talk to one of our agents and put your numbers in and you can see what's going on, right? It's not just a black box. But part of what goes on is, like, if somebody is carrying a bunch of credit card debt and other types of debt that might be rolling over at a higher interest rate than what the life company would charge you for the policy loan, and or if those numbers are higher than if someone's also funding some kind of tax advantage retirement account from their job, because that's what the gurus tell them to do, you can have a situation where someone's got this like outstanding credit card debt rolling over at a ludicrous APR, but they're not paying it down because, oh no, I'm supposed to put my money over here and be responsible. And so things like that, whereas the system that James, sort of sketched a few minutes ago, where you put in your priorities in it, it kind of just shows you the method by which we start knocking out these other debts and so forth. It makes sense when you sit back and look at the big picture to see how you're picking off these outside debts that are rolling over at really high rates. And so that's just one little piece of it. It's not like that's the foundation of the system, but I'm just trying to explain how it really is the case that your total debt can be lower depending on if you prioritize the order in which you're knocking things out rather than doing it the way you're currently doing it. So that's just one example of an objection that at first sounds really profound, but when you pick it apart, you realize, no, that's kind of a goofy thing to say.
Yeah, no, and I'll just add to that one of the things, particularly if you look at it from a net worth perspective from the clients, I mean, two things are happening. Yes, we're paying off their debt, which in and of itself is increasing their net worth. Two, we're increasing their cash flow and moving that cash flow back towards an asset that's growing for them. And speaking of that asset, the life insurance cash values, they're growing at the same time that the debt's eliminated. So it's a rapid buildup in net worth in addition to the cash flow that we're improving upon.
It's also sometimes just really useful to have a bit of a look at that. Like, so a lot of us are busy and just kind of are going through and paying off debt and just kind of accept that that's how it has to be. Something that's come up for a lot of people that we're talking about is like a simple thing is like just even doing the calculations on how much somebody's spending but like by not taking their lunch with them to work. So again, we're not, like as James said earlier, we're not telling people what they should or shouldn't do with their money, but sometimes just an awareness of that means that they could be more efficient perhaps with, how they're using their money. And so that's just a really simple example where sometimes people don't think they have cash flow, but just by kind of taking the time to examine it, they become aware that there's probably ways they could be using that cash flow more efficiently. And then, people are driving this and controlling this, so they're going to choose what direction they want to head with it. But that level of awareness and the opportunity to have someone sit with you and kind of run through those pieces is something that I've got a lot of feedback on as being hugely valuable for people, because then they can start to take more control, because it seems overwhelming at times and a little bit baffling as to how you can tackle some of these debts, especially when they've been long-standing. So just to have that level of clarity and a plan in place to be able to tackle these things is hugely beneficial for people, and something that a lot of people have fed back to us that they really appreciated about this process.
One thing I would add, sorry, Wayne, is it's a mindset, right? We have to, part of the process is to get people to think differently. And from the traditional way of thinking and what we've been taught by the talking heads, by our parents, by the government, by whoever, right? So a lot of people will say, well, if I have extra money, why wouldn't I just pay off my debt directly? Well, that's a good question. And the reason that you wouldn't do that necessarily is because what do you have at the end of the day? You pay off your debt and your debt is paid, but you have nothing left over. You have nothing to show for it. If we use this process and the product that we use, you can get rid of that debt and have an asset that's growing when that debt is gone. So you get to do those two things, and you're going to have a death benefit for the rest of your life. So you really get three things with the same dollar. If otherwise you just gave that dollar to the bank or the financial institution that holds your debt, that money's gone forever. It can never do anything for you again. And the only person or the only entity that benefits is that financial institution. Because now they're going to take your money and put it to work and make more money. So we want to take that function that the banks use with our money to make more money. We want to do that at our level and take advantage of that strategy for us instead of someone else. Go ahead, Wayne. Sorry to cut you off there.
No, that's great, George. What I find really interesting is that the thing that has caused this debt crisis is education. It's learning. It's the pursuit of education, knowledge, degree, opportunity to pursue a career, and ultimately achieve and enjoy. And so as I've talked to students that are carrying student debt and for quite some time, I think for many of them, they're a little weary or discouraged or maybe even overwhelmed. And in the conversation of learning, because really that's what caused the problem. So why don't we take responsibility for our learning when it comes to understanding economics and finance, and how do we get ahead and realize that there is an option? They become hope-filled. And just last night, I spoke with a person that's had this debt for quite some time, most of their career, and they're nearing the point where they'd like to start thinking about retirement, but they still have this debt, and to come alongside and say, we actually can help you eliminate this, but you need some fundamentals. You need a foundation. Anytime you're building a physical structure, the foundation is crucial. And if you don't have a good foundation, you're going to end up with some building issues, with some structural issues. And so I think that's fundamentally what we're talking about here is we bring hope to the situation when we start laying a foundation and say, build on this. And the comments that have been shared already by my colleagues really have been saying, hey, before you just go out and attempt to solve this on your own, why don't you take responsibility for educating yourself around how this stuff flows? Because somebody's getting incredibly wealthy off of our cash flow. It's just typically not us. And if we build a foundation that we can then build a structure upon and ultimately make this multi-generational, I just think this is so exciting to share with clients. And the client last night, I said, maybe I can't help you solve your problem, but I'm sure going to give it my best shot, and we're going to learn together, and we're going to figure out your situation together, and we're going to resolve your situation together. And I'm absolutely confident that if we can build you a new foundation of finance, you are going to have a very, very bright and hope-filled future. And so I'm just excited at the opportunity we have to serve people and bring hope into these somewhat disheartening kind of environments.
That was beautiful, Wayne. If no one has anything to add there, I actually kind of have a follow-up question for all of you here. I think that you're all going to be able to give some interesting insights. So we've really focused the space on the student loan debt crisis and how we're going to solve that through our student loan minimizer solution, which utilizes cash management whole life insurance to retroactively pay off the student loan debt that's been accumulated in someone's life. But we also have a product at Infineo known as the Child Millionaire product or solution. And the Child Millionaire solution is a little bit different than our student loan debt crisis or our student loan minimizer solution, but it could potentially be used for financing higher education for students as they grow. And so I'd love if you guys could potentially share a little bit about what the Child Millionaire solution is, the framework behind it, the thought behind it, and how it could potentially be an alternative to our student loan minimizer for people just getting started with kids.
Yeah, that's a great point, Jackson. The Child Millionaire strategy, again, it's just it's a use case for the overall strategy, and the product that we employ is a way to prevent the student loan crisis, right? So we're setting our kids up for success right from the beginning, right from day one. So we're creating a pool of capital for the purpose for our children, for their use when they are older and adults when they need that money. So the purpose could be to pay for their education. If they don't go to school, that's okay. They can use it for something else. They can start a business. They can purchase property. They can buy their first home, whatever the case may be. But they now have a growing pool of capital guaranteed that they can use when they become adults and when they need that cash. And it has more than one purpose. So traditionally, people will put their money away. In Canada, they call it a registered education savings plan. In the U.S., I forget the number, but it's a 500 number plan for putting money away for your kids' education. But that has one purpose. They only can pay for their education, nothing else. So what if they don't go to school? What if the plan doesn't go quite the way you wanted it to? So the Child Millionaire solution provides flexibility. It provides control. It provides options. You can still meet all the same objectives that you would with any other tool, with any other strategy. But now you have flexibility, guarantees, control, and liquidity when you need it. So just a better solution overall that we can provide with Child Millionaire.
The question I often ask parents to think about is, do you think your child would need money beyond their education? Now, there's a fairly obvious answer to that question. So one of my big objections to registered plans is that they're really only catering for a very specific purpose. And that's not really setting, our children up for success, right? So can you imagine if your parents provided you with something that had the value and protection that is offered in whole life insurance as you entered into adulthood? So what options would that give you? What would that change about what you could do, what you could initiate, whether you did education or not, whether you needed a car or not, whether you want to put a deposit on a house or not? So all of these other things that you would be able to do with that, and just setting people up so that, quite beyond even student loans, that people have a system in place that makes sense and can be passed on from generation to generation.
If I can jump in here, somebody protect me from myself, but I often say, who's the worst business partner you can possibly imagine? It's got to be the government. And they come up with these solutions and they invite us to engage with them. And I'm going, that just doesn't make any sense to me. But regardless, if we're trying to save for our kids' education, for their learning, for their opportunity to become productive members of society and ultimately flourish, then this process in itself is possibly the best education you could ever provide your children or grandchildren. Teach them how money works. Teach them how money flows. Teach them how to get it to flow towards them rather than away from them. Teach them how to recapture the dollars that typically flow into other people's possession and ownership. teach them how to protect and preserve and leverage their capital forever and ever and transfer it to future generations tax-free. That, to me, fires me up a fair bit for my own grandchildren to say, what a privilege to be able to educate my grandchildren so that when they're ready to pursue their life direction, they have a foundation that will allow them to go in any direction they choose with wisdom and confidence and capacity to bring value wherever they are.
Great. Thank you, guys. And it's been, really interesting for me to kind of see how we can proactively and retroactively solve the problem of the student loan crisis through cash management with whole life insurance. And so on that note, it'd be great to potentially hear about some of the other things that we can utilize cash management with whole life insurance for. We have talked about the flexibility of it here, and just looking at our audience, it seems like we've got an audience that appreciates flexibility and their freedoms here. And so let's talk a little bit more about the flexibility and what are some other things that you can do if you have a properly structured whole life insurance beyond paying down your student loans or making sure that your kid in the future doesn't have to take out loans for their education.
Yeah, it's a good question, Jackson. Number one, any debt, both personally or corporately, can utilize this solution to rapidly pay it out and still have your money when you're done. But like George pointed out, I often say that's just the boring part. More interesting part with this is using it as a financing tool to finance the purchase of investments, because there's no mathematical way to earn a higher rate of return than have your money growing in one location, leveraging against having money grow in a second location at the same time. Even the interest you're paying back on your loan to do so is paid back into an entity of which you're a co-owner from, where your money is constantly growing on the other side. So effectively, you sit on both sides of the coin. You're both a lender and a borrower. So you're profiting from two locations at once. So I mean that there's really no investment that you could tackle and come out further ahead and safer, mind you. Because, for example, if that outside investment for some reason did not work out and you lost that money, all you have is a lien against your policy. All of your money is still residing in there and continuing to compound uninterrupted as if that loan was never lien against it.
Earlier this week, I had a client contact me that was just wanting to educate herself a little bit more on finances and fundamentals. And she's a professional, she's a contractor, so she's responsible for paying her own income tax. And so in the process of our conversation, I said, this is fabulous. I mean, you've got surplus income, you've got the capacity to pick up a few extra hours a month and drive that surplus income even higher, and you're paying your own taxes. So why not save your tax dollars that you're preparing to allocate out to the government when the time is due, put them inside your structure. When they're owed, cash flow them out of your policy to pay the government your taxes and begin replenishing that pool again with the bonus interest. And you've all of a sudden isolated an expense being taxed, which is going to happen forever and ever. Maybe I'm a little pessimistic there, but my assumption is that this is never going away. And she's now perpetually able to recapture and grow her own wealth because she has figured out a way to leverage her money and use it in multiple ways. So that was really fun to just share that with her.
I think another aspect that really has appealed to me personally as well. So, we're a three-generational family, and what we can do for our children and grandchildren is incredible. So the multi-generational aspect of this process and this product is amazing. And then as we're creating their wealth and passing it to the next generation, the snowball gets bigger and bigger and bigger. That families like the Rockefellers have been doing this for generations. What we're teaching people is nothing new, right? It's been around for hundreds of years. Nelson wrote his book in 2000. He discovered the concept in his life in the 1980s when interest rates were through the roof, right? They're in the 20s. So it's nothing new. And the multi-generational wealth transfer, tax-free, is incredible. You know, the wealthy have been doing this for generations because of the tax advantages that life insurance offers. But in addition to all that, you get to use it while you're alive. So there's a death benefit, absolutely. But there's also living benefits that you can use while you're alive, your kids can use while they're alive. You're going to pass that on to your grandkids, and so on and so on, and it's going to get bigger and better every time.
I have an example. This client I'm working through a case with, and they're almost 70 years old. They're looking at what their future tax liability is going to be at the end of their life, looking at a term policy they wanted to convert, and realize what it was going to cost and how much actual death benefit will be available at approximate expected time of death for that family. And it made more sense for him to buy policies on 3 children, adult children, because the cash value growth in those policies was far in excess of the actual entire death benefit on a policy on himself. So the plan in that family is he's going to fund policies on the adult children. At the end of his life, the children will then take loans from those 3 policies to pay their final tax expenses, and yet those policies will continue to go on forever, even with those liens against them over the rest of the children's life, the grandchildren's lives. Those policy loans can be dealt with or not in this case because of the size of the numbers. But he's literally kicking money now to his great-grandchildren to the tune of more than $10 million, where initially putting in, he's only going to put in about $750,000.
Wow, that is phenomenal. And so, I mean, if you're motivated to take next steps by any of the stories you guys have heard here today, you're sitting there thinking about you'd love to implement this process to pay off your student loans, your mortgages, or anything else, or to just invest, as James was saying before, what you can do is go to the pinned tweet and click the link, depending on if you're in the U.S. or Canada, and you'll get a calendar, and you can book a call at your convenience, no cost, no commitment, with any of our panelists you see here on this call. You'll be paired with one of them and get a call. And so we highly encourage you to do that. As we're coming up on time here, guys, I just kind of want to open the floor to you guys for some last thoughts around the U.S. student loan crisis. Are there anything that you guys are looking forward to seeing this year play out in terms of potentially the crisis being minimized? Is there any actions you think legislatively that can happen, or are you really just hoping to see more and more people start adopting our student loan minimizer solution and utilizing that to retroactively pay off their debts? So I would just love to hear your guys' outlook on kind of the crisis.
Yeah, so I'll jump in. As I think you open the possibility for, I think it's a fool's errand to be looking to Washington. That, if someone's out there listening who's got student loan debt, I think, you got to just suck it up and realize it's up to you to knock that thing out. And, go ahead and get the infrastructure up and running. As Liz mentioned, this solution we're showing people how to implement, it's very flexible, right? So even if you set the thing up and then you get into it and realize, oh, wait, there's other priorities that come up, or if the government did forgive your debt or whatever, or give you a 2-year hiatus, it's not that you would slap your forehead and say, oh, geez, I wish I hadn't done this. That no, once you get one of these policies up and running, you can adapt it to do all sorts of things. It's very flexible and robust. So I would encourage people just to go ahead and assume the worst, and then maybe you'll be pleasantly surprised.
That's how I look.
Sorry, Jackson. I would say certainly that you do not want to rely on anyone else to help you solve your problems. You want to take control. So yeah, that would be my advice to people is take control, make it happen for yourself. A plan is a place from which to deviate. So plans can change. However, the flexibility is built in. so that you can change with whatever life throws your way. So, sometimes priorities, objectives, goals change, right? And they will change over our lifetimes. And this process, this strategy will change right along with you. So that would be what I would say.
When's the best time to plant a tree? 20 years ago. When's the next best time? Today. And that applies to this as well. So kind of to play off what Dr. Murphy and George was saying is that this is flexible, but it's something that you will, I hear often, I wish I knew about this 20 years ago. So if you have an opportunity to do something and, adapt it for whatever you need it for, then it's certainly something that, you'll benefit from over the long run.
Beautiful. And so if we don't have anything to add here, I think we can wrap this up a couple minutes early. What I'm going to do right now is I'm going to pin another tweet here. We have a really exciting whole life insurance space coming up in 2 weeks. Our next whole life insurance space, we're going to be featuring the #1 voice in infinite banking on X. His name is Nate Dean, and his Twitter is @ChroniclesNate. And we're going to be walking through kind of the basics of cash management with whole life insurance. So if this was a little too much and you need to take a step back, you need to learn a little bit more about the process we're talking about here, it'll be a perfect space for you. And so I've pinned that tweet there. I highly encourage you to set your reminder. That will be in 2 weeks on May 7th, I believe, May 7th. And with that, we really have had a great conversation here today. If you're interested in tuning into our real world asset tokenization spaces, those are going to be occurring on alternating weeks as well. So that'll be next week. We're going to have Concordia on, and we're going to be evaluating the on-chain risk analysis that they're doing and how it differs from other protocols like Aave and Compound. And so that'll be a really fun conversation. So if you're interested in that, just stay tuned on our Twitter @Infineo Group. And with that, I just want to thank our panelists one last time for being here and our audience for listening. We really, really appreciate you guys. And yeah, thank you everyone for being here.
Thanks all. Have a good one.
Thanks, everybody.